So it's a great pleasure to have Shalva here today to talk about this project that he's been working on. Shalva, how long exactly have you been working on this modeling project and this paper in particular? I'm curious what the background was behind this paper.
In terms of working on this particular paper, I think about a year, but I wouldn't say that all that goes into this paper that I learned in 1 year. Of course, my whole career I've been trying to understand this topic, how money creation really works, and then at some point I decided to write a paper on this, and so it took me something like a year to fully develop the model, flesh out details, and then write a paper.
Okay, good. So I don't want to waste any more time. Shalva used to be the head of the macro, what I call the macro directorate at the National Bank of Georgia. But now, recently, he's moved to the IMF, and I think you're in ICD,
Yes.
uh, which is capacity development and so on. So anyway, it's a great pleasure. Well, let's jump straight into it. I'm very excited to look at the details. I just listened to the podcast on our Better Policy Project website, but I never looked at any of the equations or anything like that. So I'm very much looking forward to this.
Um, Thank you very much, Doug, for the kind introduction. Let me share my slides. Okay, now you should be seeing it in the full screen mode. Again, thanks, Doug, for the opportunity to present this paper here and for everyone participating. So, as I mentioned, I've been working on this topic for many years, but in terms of this paper, this is relatively new, and I think it's a very important one, as we will see, something that uh, most of the literature is usually kind of missing or kind of don't appreciating the importance of this topic. So in terms of the title, so you can read it in both ways. It's either inside money machine, which is essentially how inside money is created, or inside the money machine, which tells us that how money is created. This is both are correct because inside money and then money in modern economies are almost the same because we mostly use inside money, which is deposits that banks create to be differentiated with cash, which is outside money created by only central banks. But because they are convertible at par, convertible one-to-one with each other, so that's why we usually say that inside money and then just money, they are one and the same thing. And as we will see, to understand how money machine works, we need to understand what banks really do. And then we will argue that it's liquidity, maturity, and then credit risk transformations that banks really do. That's how they create money. And then just a couple of words about the literature. A nice summary from Charles Goodhart in its paper, arguing essentially what we are arguing today, that the current literature is not taking the evolution and mechanics of money creation seriously enough. And then the quote is, among the worst shortcomings of monetary economics are standard theory of the evolution of money. So a couple of papers are closest to our model. For instance, one of them being co-authored by Doug. This model does kind of a deal with inside money creation, but one thing that they do not cover is liquidity risk and then liquidity transformation. That will be part of our model as well. So apart from these couple of papers, which I would say is kind of an exception rather than a rule. Most of the literature covers banks either in a very simplistic manner or trying to portray banks in a way that do not really correspond to the real life counterparts. So that has been a motivation for my work. On the other hand, central banks have been frequently emphasizing this aspect that money is created endogenously and it's created by banks. For instance, Bank of England had this well-known paper about a decade ago where they argued that banks do not simply act as intermediaries, as some textbooks portray. They actually create deposits when they lend. Also, this quote from Bundesbank saying that bank's ability to grant loans and create money has, and this is my emphasis, has nothing to do with whether it already has excess reserves or deposits. And as we'll see, this may not be all the way true. It's true that banks create money when they grant loans, but there may be some role for what is the liquidity situation, what is going on with reserves or deposit outflows at banks. So, and the reason why there is some confusion, probably even though central banks understand this is closer to truth, probably the reason why they kind of went all the way to the other extreme, saying that it has nothing to do with liquidity situation, is probably the reason for that is the absence of simple or tractable model to structure our thinking, how this process works. So I think having this simple, and I'll be emphasizing this part, simplicity and intractability of the model is probably important to have a tractable model to understand how money creation works and what kind of constraints banks face in this process. So the model will have two big parts. One is financial sector, mostly banks, and then we will also explicitly model the balance sheet of the central bank. And then we will have a non-financial sector, which will be mostly pretty standard. But the key emphasis is on the banks. So what banks do in this model, and I would say as in real world, is they create money by liquidity, maturity, and then credit risk transformations. So what does it really mean? It's a very simple process. In a nutshell, what banks do, they issue one type of liability, and this will be what we call deposits. That's liability of the bank. They issue this liability or create this liability as you wish, and they exchange this liability for another type of liability, someone else's liability against this bank. Naturally, this means that it will be an asset for the bank. And this is their kind of a main business model. They make profit from this process, from issuing one type of liability and acquiring some asset, someone else's liability against them. The trick is that the liability that banks issue, it's liquid, it's short term, it's low risk, and more importantly, they are, and actually as a result, is used as a widely accepted medium of exchange in the economy. We make payments for these goods and services and assets like houses and so on. And their ability to issue this kind of liability is used to buy an asset that true will be illiquid, it will be longer term, it will be risky, but it will be profit generating. So the bank's ability to issue this kind of liability that's used as a medium of exchange, they are using this kind of ability to generate profit. And this profit will be essentially from interest income from loans. So this is from liquid short-term to low risk. They actually from illiquid long-term and risky assets, they create this short-term liquid short-term and low-risk liabilities. And that's essentially liquidity, maturity, and credit transformations. But naturally, this also means that banks will be exposed to some risks, to liquidity risk, to the maturity risk, and then to credit risk. And then we will be modeling how these risks actually create some constraints for banks in their ability to create money. And as we will see, there are two couple of key frictions in the model that will generate these constraints on banks. To constrain banks in their ability to create money. The one is minimum capital adequacy constraint. This is something that DAX model also incorporates. This will be generating credit risk premium and also tying the hands of banks to issue excessive amounts of money because they would need capital to deal with the resulting credit risk on their asset side. But on the liability side, they also have some constraints. They have a liquidity risk, and this liquidity risk is generated by the presence of finite and, in most cases, relatively, compared to the whole financial sector, relatively small collateral base for central banks' monetary operations. So that second constraint will be creating liquidity risk premium, and that will be an additional force that constrains banks in their money creation ability. So just with a couple of preliminaries, what kind of balance sheets are we talking about for the commercial bank as well as for the central bank? For a commercial bank, what we have is on the liability side, we have deposits and equity. So that's pretty standard, nothing really special here, except that we differentiate between retail deposits and then wholesale funding. And this wholesale funding on an aggregate level for the entire banking sector, this wholesale funding can only come from the central bank as the monopoly supplier of domestic currency reserve balances. On the asset side, though, we need some differentiation. As we mentioned, we need to understand liquidity risk, maturity risk, and credit risk. So that's why, apart from the central bank's reserve balances, which have no maturity risk, they have no liquidity risk, they have no credit risk. Apart from that, we need three additional assets. We will have risk-free securities, which have maturity risk, but they don't have any liquidity risk because they're part of central bank's collateral base, and they don't have any credit risk because we abstract from sovereign defaults. Then we will have safe loans, which will have maturity risk and will have liquidity risk, but they will not have credit risk because we assume that they are backed by some assets that households own, like company shares or physical assets, whatever. There is no credit risk for this type of loans. And finally, we have risky loans, which have credit risk, which have liquidity risk, as well as generate maturity risk. So this means that interest rate on these four types of assets will be different, thanks to these differences in what type of risks they are exposed to. On the central bank side, we have, again, relatively simple balance sheet. On the liability side, we have central bank issued money, either cash that the entire economy can hold, or reserve balances that only banks can hold, for instance, to satisfy reserve requirements and so on. On the asset side, though, we have two types of assets. One is refinancing loans, something that we will be using to understand how much liquidity central bank is providing to the commercial banks, in this case on a lending basis. So that's kind of a non-net domestic asset type of representing net domestic assets. And then we will have this FX reserves stock, international reserves, like net foreign assets. So net domestic assets and net foreign assets, those are two types of assets that the central bank can hold. In terms of the timeline in the model, the important thing is, actually two important things are, we need to generate demand for loans, and we need to make banks exposed to this type of risks. And our assumptions in terms of the sequencing or ordering of decisions makes banks exposed to these risks, the liquidity risk, credit risk, and so on. So the sequence is as follows. So first, banks extend loans. They extend loans to, they buy government securities. They extend loans to safe borrowers. They extend loans to risky borrowers. And then they set interest rates on those loans, as well as non-financial sector does their thing. But then comes this next time instant, which will be very close to this initial and very close to the beginning of the period. And at this second in time instant, in this case, it will be tau prime. The risks are materialized. Depositors decide how much money they want to withdraw from this bank, either transfer to another bank or withdraw as cash. And central bank is also deciding on its policy rate and all its policy instruments at this point, so that banks, when they extended loans, they didn't know exactly what policy rate the central bank would set. That's why they are exposed to this maturity or interest rate risk. And when depositors decide how much money to withdraw from this bank, after banks have extended loans, that's also the reason why these banks are exposed to liquidity risk. And then also we have this materialization of the credit risk on the entrepreneur side, which some of them just default on their projects, and they because of these failed projects, then they find it difficult or impossible to repay their loans. So that's why banks are exposed to credit risk as well. And then eventually, at the end of the period, we finalize the period by making all the payments, loans are repaid, and then the next period starts. So this is kind of the assumption that we have here in terms of sequencing is what generates the risks for banks, the risks that they face. And also we generate demand for loans because we assume that non-financial sector like households and entrepreneurs, they need to obtain money at the end of the period to commit to their payment needs for their expenditures like consumption or investment because they need to do this at the end of at the start of the period that generates demand for money balances, which they can only get from banks by borrowing. So that's why we have this loan maturity being equal to the whole period. And then the liquidity needs, potential liquidity needs for banks will be a slightly shorter time period. But because of our assumption that these tau prime and tau are very close to each other, we assume that this liquidity borrowing from the central bank is of the same kind of a duration as the loan. So there is a significant time period when banks may need to somehow get liquidity to satisfy deposit outflows. And as we will see, the most models assume that banks are kind of frictionlessly able to obtain liquidity from the wholesale markets to satisfy deposit outflows. But as we will see, in some cases, this may not be true. So now going to the equations. So let's start simple to understand the mechanics again, because the simplicity was the one of the key objectives. So let's start simple. We say that what banks really do is that they try to maximize their risk adjusted or probability weighted return on equity. On this slide, we don't have any risks yet. We will be introducing them later. So at this point, we just assume there are no risks. If there are no risks, there is no risks that constrain banks' ability to create money, and there are no demand constraints. Then what banks really do is they try to maximize their return on equity subject to balance sheet identity. So that's the bare minimum of the constraints that banks need to face. Their balance sheet identity needs to be satisfied. And in fact, that's the idea where endogenous money creation is embedded into the model. We say that if banks, within their optimization problem, if banks decide to increase their asset side and therefore generate interest income, they must increase their liability side and then expand interest costs. So that's the kind of the idea. And then because we assume that households and companies and entrepreneurs they cannot really use reserve balances at the central bank, and they cannot use equity as for medium of exchange purposes. That means when banks extend loans, they must issue their deposits, so more deposits as well. That's essentially money creation. When banks extend loans, they expand their balance sheet, both assets as well as liabilities, and they create money simply because they create deposits. And as we mentioned from the very beginning, deposits equals money. So if we don't introduce any demand constraints or regulatory constraints or risks, what is the solution of this maximization problem? It's very simple. Those variables that enter objective function with plus sign, they will go to plus infinity. And banks will set high interest rates on loans, not facing any demand constraints. They will just generate infinite profits. And by the way, they will also set equity at the minimum level at zero, essentially. Without any capital, they will be generating infinite profits. That's what sometimes people call creation money out of thin air. In this simple example, banks do really create money out of thin air, or what they call ex nihilo. But as we will see, this is not very realistic. Banks do face constraints. They need something, or something is constraining them, which means that they do not really literally create money out of thin air. It's probably just a metaphor to emphasize that banks create money even though they are subject to some constraints. So what are those constraints? Again, having simplicity in mind, so we try to introduce only those constraints that are key in the real world. And I think the demand constraint is probably the most important constraint. And the way we introduce those is simply adding some constraints to the bank's optimization problem that would create um, this dependence between interest rates that banks set and the amount of credit that the rest of the economy would demand. For instance, if I'm a household and I go to the bank and I need some amount of money, therefore I need to borrow from the bank, I would probably pay attention to interest rate. If bank sets too high an interest rate, I will likely reduce my demand for loans. I will somehow either reduce my consumption plans down, kind of downsize my consumption plans to avoid these too high interest rates, and then so on. That's why we just assume this is a very simple assumption, and in fact, it follows the standard Stiglitz CS approach, constant elasticity of substitution, which says that when interest rates increase, loan demand declines. That's the only key idea that we need. If we just add those constraints to the bank's optimization problem, then the solution becomes finite. The interest rates on asset side will be essentially a constant markup over deposit interest rates. So banks will be generating some profit, some finite profit, because loan and credit and asset side interest rates will be higher than deposit interest rate by the amount of markup. But the profit will be finite because interest rate spread will be finite and quantities will also be finite because demand constraints will give this finite quantity. So at this point, we see that banks still do this kind of inside money creation thing, but not infinitely. So they're not unconstrained in doing so. There is no kind of a creation out of nothing, which would probably mean that they could do as they wish. But here they cannot always do as they wish. They are constrained. So now endogenous money creation still happens, and as we will see, this is important still. Because it means that banks are much more flexible. If there is demand, they can quickly generate credit booms and then busts. That's still important. But that doesn't mean they don't face any constraints. They do. They have these at least demand constraints. But then we will introduce a couple of risks that will also create an extra set of constraints that banks face. So the first one will be this liquidity side. On the liquidity side, we mentioned that if demand for outside money or demand for central bank issued money or demand for cash suddenly increases, or there is simply some deposit outflows from some banks to other banks, if there is, and then this is, by the way, this is kind of how much deposit outflows banks will face, as we mentioned in the timeline slide, is uncertain for the bank at the point when they issue loans. So this is kind of a stochastic kind of uncertainty for banks. But when this uncertainty is resolved, when depositors decide to withdraw their money from this bank, then this particular bank will need to find some wholesale funding to satisfy these deposit outflows. And the way they do this is at the systemic level, at the banking system level, they would need to borrow from the central bank. Or we can also assume that banks can issue some repo or borrow from other banks on a collateralized basis. But they need collateral. That means they need collateral either to borrow from other banks or to borrow from the central bank. At the systemic level, again, they can only do so from the central bank. But central bank requires collateral to lend to banks. Even though when we usually say that central bank, at least central bank can create money out of thin air, they can just print cash. But that's not exactly true because when we say that central banks can issue liabilities, they can expand their balance sheet, they can print cash. In today's financial systems, monetary systems, central banks can only buy assets. And there is only so much assets that they can buy. They can buy foreign exchange, they can buy domestic government bonds, they can probably buy some high rating, relatively low risk, potentially corporate bonds, but those are finite. They cannot really buy banks' risky lending portfolios. because central banks need to be need to they need to avoid taking credit risk themselves. It's only in combination with fiscal policy that can take credit risk that central banks can really limitlessly expand money supply. But in normal times, without fiscal policy backing explicitly, they trying to avoid credit risk on their balance sheet. There's only so much assets and only so much liquidity they can provide to banks. And this in this model, this is somehow represented by collateral base. So why do commercial banks need to have these collateral eligible assets? Because again, they are subject to liquidity risk because they don't know how much money, how much wholesale funding, or how much liquidity they would need to satisfy deposit outflows. So what is the demand for money? Demand for central bank money? It's some of two things. One is this QT. And, let me use laser point here. So this QT is reserve balances that banks hold at the central banks, for instance, to satisfy reserve requirements, plus demand for cash from the general public, from companies and from households. And this C hat is random variable. Banks do not know realization of this ex ante. So they don't know this, but once it's realized, then this amount of cash will be demanded by the rest of the economy. And by the way, this in the parentheses, it's essentially the deposit portfolio, but expressed using the balance sheet identity of banks. So this demand for cash, which is stochastic, plus demand for reserve balances, minus the reserve supply that central bank provides using some other instruments like buying foreign exchange, that is also a source of domestic currency liquidity injection. Apart from this demand for
What is risky and not risky? That's what I was really wondering about
yeah,
when
so
I asked, why are you separating those two things? Like, is
because
it just
yes, one type of loans that we call safe will not have credit risk premium, and then the other type of loans, so which is risky, they will have credit risk premium, and that has its own kind of dynamics. So just to differentiate different types of interest rates, one that incorporates liquidity risk premium, and the other that incorporates credit risk premium.
okay? And this is the idea to make things simple. Is that
Yes,
uh,
yes. So I don't
so?
differentiate
This is
between mortgages or whatever other types of loans. I just assume that whichever loans don't have credit risk, they are bundled together in this group, and then the rest risky ones are bundled together, whether mortgages or business loans or whatever.
okay. Good.
Yes, and here we were saying that there will be some demand for liquidity, but this constraint says that this amount of liquidity that banks will need to borrow from the central bank needs to honor this collateral-based constraint. This borrowing from the central bank, this RT, which is refinancing loans from the central bank, needs to be less or at most equal to the collateral base. And then collateral base is essentially haircut adjusted sum of collateral eligible assets divided by the gross interest rate because that's the amount that banks will need to repay back to the central bank. What this means is that there will be some probability that banks may run out of collateral. This realization of C hat, because this is a random variable, this realization of C hat, if it's too high, then banks will not be able to satisfy all of the deposit outflows because they won't be able to substitute deposits with retail. They won't be able to substitute retail funding with wholesale funding, which means they will be forced to downsize their balance sheet, which is essentially deleveraging. And that's how liquidity risk can generate credit crunch. On the asset side, so again, we have this very simple constraint, which tells us that because banks are exposed to credit risk and they are exposed to credit risk because of this risky loan portfolio, some random fraction of these loans will become non-performing right after banks extend loans, and they will be deducted from the equity. And banks need to make sure that these losses, loan losses, should not be too high to make equity go below the required minimum. And required minimum is essentially a multiple of minimum capital adequacy ratio times the risk-weighted assets. which also means that depending on realization of is it delta hat because of that realization of credit risk for some realizations banks will run out of equity or their equity will fall below the required minimum, and at that point we assume that banks default or central bank steps in and changes the management or whatever they have some heavy supervisory action. So what this means is that if we now look at the risk-weighted or probability-weighted profit of banks, there are a couple of possibilities. If capital falls below this minimum, then banks get zero profit because they have this limited liability. They just default and don't get any profit. But with the rest of the probability, they have two options. One is they may run out of collateral. And in this case, they will get this profit, this amount of profit, which can be very low due to high costs of liquidity stress. Or if they don't run out of collateral and their business is functioning normally, then they will get this amount of profit. So this profit in those two cases, how do they look like? So in normal case, the profit is the same kind of an interest rate interest income minus normal interest expenses, which is interest expense on retail deposits, interest expense on wholesale funding, minus some non-interest net costs, net non-interest costs. But if they do face deposit outflows and they run out of collateral, then the whole deposit portfolio leaves this bank. And we say that banks have liquidity crisis. And the liquidity crisis comes at the cost. This chi parameter is what measures, in a simple way, measures the cost of liquidity crisis. And it can be quite high. It can be so high that banks can generate so little profit or negative profit, then it can make equity go below the required minimum, which will be equivalent to liquidity-induced solvency crisis. Okay, so that's pretty much it. So these are very simple constraints. And if we add those into the optimization problem, then we get this type of first order conditions or solution, kind of the equation that describes the evolution of interest rates. So let's discuss the safe loan interest rates. So there will be some normal drivers like markup. They will have loan interest rates will need to compensate for expected retail funding costs. They need to compensate for expected wholesale funding costs, and in retail and wholesale, they are split with probabilities. So if there is deposit outflows, they have to pay these wholesale funding costs. If deposits stay, they have to pay lower retail deposit cost. And they also need to, the interest rate need to compensate for the possibility that in some states, in some situations, banks may run out of collateral. They will have liquidity crisis, and that's costly. And with that, with the respective probability, loans need to compensate for that. So this seems pretty kind of a standard or easy to understand. But then we have two big terms, which will be first, it will be credit risk premium, and then the liquidity risk premium. So for both, these premiums are essentially quantity of risk times the price of risk. So let's discuss each in turn. So the credit risk premium for safe loans is still there. Even though we say that there is no credit risk for these type of loans, there is still some credit risk premium. That will be different from risky loan interest rates, but still. Why do we have still this premium? Because central bank doesn't know which loans are risky, which loans are safe, and they still apply some risk weights, positive risk weights to these loans. The central bank is asking this bank to hold proportionally higher equity, even if they extend safe loans, because central bank doesn't know whether this loan is safe or not. And when this omega, and then by the way, this omega SL is risk weight. So in here, you remember that we have these risk-weighted assets, and this risk-weighted asset, I probably forgot the equation. Risk-weighted asset equals sum of risk-weighted adjusted assets. And these omegas are risk weights. So because of this risk weight, because there is still some requirement to hold equity, more equity if banks extend safe loans, then this equity needs to be, the cost of obtaining this equity needs to be compensated by loan interest rates. So the left part is essentially quantity of risk or quantity of need for equity times ROE, the return on equity, which is price of equity. On liquidity risk premium side, we have similar picture. So what is the liquidity risk quantity? It's this frequency of deposit outflows, which is small f c hat. This is probability distribution function of cash demand. This is quantity of risk. And this quantity of risk is adjusted by whether these type of loans that banks will be extending, do they generate liquidity risk or do they insure liquidity risk? If the haircut within the collateral base of the central bank, if the haircut applied to these type of loans, in this case to the applied to safe loans, is it higher or lower than the average haircut? If haircut is higher, it means that this loan extension creates deposits, but these deposits can leave this bank, and this bank may not have sufficient collateral to satisfy this deposit outflow, so their bank is exposed to liquidity risk. And therefore, this asset or this loan creates liquidity risk by this amount, by the frequency of cash demand. So that's kind of a quantity of liquidity risk. The price of liquidity risk is on these square brackets, and it has two components. And then in total, they are cost savings that having collateral eligible assets give you. So when you insure liquidity risk, you essentially make sure that whole retail deposits do not leave your bank, which is beneficial for you because wholesale funding is costlier because this IR is higher than ID. Because of this, if you retain retail deposits, your profits are higher. So that's the benefit of having liquidity insurance. The other benefit is that you avoid liquidity stress cost, which is this represented by this chi parameter. So this cost savings, if you avoid liquidity risk, is price of liquidity, insurance of liquidity risk. And if you extend some loan that generates liquidity risk, its interest rate better compensate for that price. So that's kind of a liquidity risk premium and credit risk premium. We have something similar for risky interest rates, but it has a bigger credit risk premium because now we also incorporate this marginal impact of extension of this type of loans. Its marginal impact on the overall risk exposure, overall credit risk exposure. Because when you extend risky loans, you not only need to have higher equity because of regulation, but you need higher equity because even when you didn't have any regulation, these type of assets can still make you default. Even if central bank requires zero capital, these type of loans can still make your equity fall below zero, and then you will default and you will forego all the profits. So that, and liquidity risk premium is essentially the same, except the haircut part is different. In terms of bank equity, the optimal decision for banks will be to hold positive equity buffers. Unlike most models, here we understand that if banks are allowed to hold any amount of equity, they will still hold positive amount of equity above regulatory minimum because they need to ensure their credit risk. Because if credit risk materialization is so high that they default, then their money creation ability is gone. So that's why they, even though equity is costly, they still hold a positive amount of it. But if we were to assume that banks adjust their equity period by period without any frictions, then we wouldn't get interesting dynamics. Instead, we assume that banks need to accumulate equity via retained earnings. So this is sometimes key, and then it's probably in line with reality, especially when we need to understand macrofinancial linkages the most, because when there are some stress in the banks, it's exactly the time that new investors do not inject equity. Banks are forced to obtain or boost their equity position by retained earnings. So that's kind of the additional assumption. If banks default, then there is no addition to equity via retained earnings because their retained earnings are non-existent. But if there is no default, then banks do expand their equity by retained earnings on top of dividend payouts. So the non-financial sector is pretty standard, so I will quickly go through them. The only thing that we add is essentially this interest elastic demand for money balances. We say that if there is difference between money holdings relative to consumption plans, then households will incur some quadratically increasing costs. So this is a very simple way of kind of generating demand for loans. Is essentially having money as a medium of exchange type of thing, but in a way that makes demand for loans depend on interest rate as well. And this money by households can be get first by borrowing from the banks, but they can also sell their equity, their shares in banks, and that's how they also can get money. But in the baseline version, we will assume that foreigners hold banks, so there is no possibility for households to expand their money holdings by simply selling equity in the banks. If households own foreign exchange and central bank buys this foreign exchange, they will also get money. But this can be kind of not endogenously linked. We can assume that some central bank's FX interventions is related to something else. It's not really related to banks or households' decisions. And finally, if government borrows and spends this money and these receipts go to households, that can also generate some money balances for households even without borrowing. And this part is probably important and could also be realistic in some cases, but not in every case. If households simply get some wages from public sector, public service, or they get some transfers that they can generate money holdings without borrowing, but not always. And by the way, if we do this optimization problem of households and linearize the equations, then we get a very standard dynamic IS equation. It's essentially what every DSG model has, every standard simple DSG model has in it. The only addition is this part, which essentially tells that if money balances have their own fluctuations, for instance, banks suddenly decide to misprice credit risk or liquidity risk and they expand their credit too much, then money increases in money creation can generate a consumption boom as well. And by the way it looks in this linearized version, this term looks very much like what preference shocks look like in linearized DSG models. So it's essentially somehow micro-founding those preference shocks, but having explicit interpretation that it's if banks have their own reasons to expand or contract money balances, money supply or money creation, then that can have implications for consumption beyond the standard drivers like permanent income and interest rates. The producer side is pretty standard. They just produce goods from labor and capital. We have distributors. The only objective of having distributors is to generate Phillips curve. That's the only thing. And then we have entrepreneurs that also do very similar stuff to standard DSG models, except additionally that they also need to have money balances equivalent to their investment expenditures. Again, money acting as a medium of exchange. That's the only thing. So non-financial sector is pretty standard and simple. The only thing we wanted to have is to have demand for loans, demand for money balances, and therefore for loans. But we have a more nuanced policy side. We have monetary policy that decides on policy rate, but we also have central bank deciding on liquidity operations like collateral eligibility, haircuts. We have macroprudential policy deciding on capital adequacy ratio as well as risk weights for each asset of the banks. And we have fiscal policy. So now let me quickly go through some of the impulse responses to show the mechanics of the model. So let's start with the standard thing that most DSG models show. How would the model understand if central bank changed interest rates out of blue? That we have a monetary policy shock. In this case, expansionary shock. When interest rates decline, policy rate declines, and lending rates decline a bit later because we have this maturity mismatch, and then the loans are extended before central banks makes decisions, so they need to adjust after the fact. But once interest rates decline, then lending expands as well. And as you see, risky loans expand the most. Why? Because when interest rates decline, loan interest rates decline more than deposit interest rates because of demand constraints and these constraints from risks, liquidity risk. Because of this, the lending spreads are compressed, which means that banks now have lower profit. And then, by the way, it's true that macro expands as much as standard ESG models would predict. Output expands and prices expand, as well as price of physical capital, employment, and so on. But I was saying the key thing is that even though liquidity side doesn't change as much, when lending spreads are compressed, banks have lower retained earnings, lower profit, and therefore capital declines because of this smaller profit or smaller retained earnings. And by the way, initially here, capital jumps up because of positive realization of maturity risk or interest rate risk. Banks didn't expect declines in interest rates, and therefore they set deposit rates relatively high. But then came central bank that reduced the interest rate, and they suddenly somehow find it possible to obtain liquidity at a lower cost, even though they incorporated higher expected cost into their pricing. So in the first period, return on equity jumps up because of this interest rate risk materializing on the positive side. But later, because of compressed lending margins, then capital buffers decline, and this makes banks essentially exposed to credit risk. And then they also don't price capital credit risk premium as much because they're hungry for profits and they are okay with a bit higher default risk. They essentially take on more credit risk just to expand their profits. And what this means is that risky loans increase more than safe loans. But it also means that, and here we have probabilities. So bank default probability rising about almost 3 times than before the issue. It means that banks now have a lower equity and they face eventual increase in policy rate with lower capital buffers, which means that once central bank does increase its policy rate, then these risky loans will have also bigger decline. So it's kind of a boom bust cycle, much more pronounced for risky loans because of credit risk channel of monetary policy. Now, liquidity risk side. So in this scenario, what we assume is that we have some very big shock to cash demand. I imagine we are in the first phase of COVID when people increase demand for cash, and this is actually something that Georgia, as well as many other central banks, went through. Demand for cash increased considerably. Banks started to satisfy this demand for cash by obtaining liquidity from the central bank, but concerns arose that maybe banks will run out of collateral to obtain liquidity from the central bank. Even though in this simulation, as you see, demand for cash or demand for liquidity doesn't go above collateral base. So banks have enough collateral to satisfy the current demand for liquidity, but they may not be able to satisfy any extra demand for liquidity. So they are more anxious about the liquidity risk and in the next period, for the next period, and therefore they incorporate much higher liquidity risk premium into assets, into loans, which generate liquidity risk. And then, by the way, here we have this increase in probability of bank runs because of these concerns that collateral may not be sufficient. So when liquidity risk premium expands, we see that interest rates on assets that generate liquidity risk shoots up, like risky loans as well as secured loans. They increase similarly because they both generate liquidity risk. They are both not part of collateral base, which means that when banks extend this type of loans and create deposits, this deposit may flow out and banks will not be able to use these loan assets to obtain liquidity from the central bank. On the other hand, banks hold securities, government bonds, which is part of central bank's collateral base. And now collateral became so valuable that banks actually can live with so compressed yields or so compressed interest income for holding government bonds bond yields declined by about 5 percentage points, and banks are still willing to hold this type of assets. Not because they expect high interest yields or high income from these bond yields, but because they insure their liquidity risk because they are part of collateral base. So that kind of while loans incorporate this liquidity risk premium, securities or risk-free bonds incorporate collateral service premium, which is essentially flip side of liquidity risk premium. Because of this shoot up in lending interest rates, lending volumes decline naturally, and then broad money creation declines as a result because of the deleveraging, which means that the real economy side also gets hit, output declines, and so on. But here we also have, because banks increase their interest rate, their return on equity increases as well. And by the way, this is probably one of the weakness of the current version of the model because we don't have credit rationing. We don't have banks cutting loans beyond interest rate hikes. And because here interest rates increase, by definition, interest income also increases, which helps banks increase their capital buffers to somehow moderate their liquidity risk. And this is also an interesting part. When banks suddenly realize they have higher liquidity risk, they increase equity. And this is kind of an endogenous and important part of the model. They increase equity because increasing equity, one, even though it kind of reduces their credit risk and default risk essentially to zero, this increase in equity essentially makes banks depend less on runnable liabilities like deposits. And that's why in the model, there is this important link between how much liquidity risks banks take and how much credit risk they take. They have some preference for the overall risk. So imagine they have some preference for some simple sum of credit risk plus liquidity risk. If liquidity risk rises, then banks will try to deleverage. And in this process, they will reduce credit risk as well as liquidity risk. At the end, then liquidity risk will be a bit higher than before, and credit risk will be a bit lower than before, but their sum will still be somehow the same as before. So banks try to trade off between how much credit and default risk they take and how much liquidity risk they take. So liquidity and credit risk are related in the model. So let me skip a couple of simulations. So this is simulation when banks initially didn't. So this is essentially simulation where banks didn't realize they were facing credit risk and they suddenly reappraised their uncertainty. So it's kind of a mispricing of credit risk. The model also generates this credit crunch in this scenario. Nothing else happens here. What we do is essentially initially banks have zero capital buffers. So they think that there is no credit risk, but suddenly they realize that there is credit risk. And then they shoot up their interest rates, especially for risky loans, because those are particularly costly. They are what generate credit risk. And they do so to build up their capital buffers. And then in the process, they generate deleveraging because of higher interest rates. Okay, and let me skip this part and go to the, for the sake of time, go to the final simulation, which is, and we can go back to this if there will be some questions. So now let's assume that government expands its debt permanently. So there is a permanent increase in government debt. What will be the implication of this? So if you go to the standard New Keynesian models, the implication is that if government spends this amount of deficit into the economy, then you will have a temporary boom in output and prices will increase. If you look at the fiscal theory of the price level, it tells you that price level needs to increase because higher government debt needs to be financed by future primary surpluses. But if future primary surpluses are not adjusted, then it must be that price level that has to adjust. But in the model, we somehow bridge those two views. We bridge by endogenous money creation. Because in this model, we assume that it's banks that hold government securities, which is true in many countries, but may not be true in some countries. In those countries, then other interpretation will be kind of relevant, but it has like a qualitatively similar flavor. Because banks hold government securities, essentially banks are who lend to governments. What banks can do if government increases their borrowing and spends this and price level has to increase, then what can happen is that private sector can borrow less. And so that in the simulation, you see that broad money doesn't change. Public borrowing as well as private borrowing, they both create money in the model, as in many cases. And because now in this scenario, they move in opposite directions, the broad money doesn't change. And therefore, the rest of the economy doesn't change as much either. We just have a couple of places where there are permanent shifts. There is a permanent shift in interest rates. As you see, interest rates on securities or government bonds permanently increase. Why? Because more portfolio of government bonds means that collateral base has expanded on its own without any decisions by banks. So banks now have more liquidity risk insurance. So liquidity insurance is less beneficial now, so that banks try to hold less of government bonds unless there is higher interest rate, higher interest income on those type of assets. So essentially, government bond supply increases, their price must decline. That's kind of a simple thing, but generated by liquidity risk side. On the other hand, risky loan and a safe loan, just loan interest rates decline. Why? Because those are assets that generate liquidity risk, but because banks are now less concerned about liquidity risk, they can live with more liquidity risk creation even at the lower interest rate. They need to lower interest rates because when they want to expand these type of loans, there must be some demand for it. And by the way, when we talk about crowding out, in this model, you see that crowding out does happen, but it doesn't happen because of scarce loanable funds. In the like standard macro models, crowding out happens because of loanable funds theory. When banks lend to government or investors lend to government, they have less loanable funds so that they have to lend less to someone else. But in the model, this logic doesn't apply. Here, crowding out happens because of credit demand. Because we assume that when government borrows and spends, this spending eventually goes into the hands of the households or entrepreneurs. Because households now hold more money balances thanks to government transfers or whatever, they need to borrow less from the banks because now they already have money balances to back their consumption plans. So it means that crowding out happens because of credit demand, not credit supply. And it has implications for interest rates, exactly because lending interest rates go down, not up. In loanable funds theory, when government borrows, then private sector credit interest rate goes up because of scarce loanable funds. Here they go down because of less credit demand from the private sector. And then this is essentially a simple way how the model bridges these two views, like a money-centered view or New Keynesian view of price level and the fiscal theory of the price level. The only addition we need to add to this fiscal theory of the price level is understanding that it's not just government bonds and outside money that represent public sector's liabilities. Public sector also promises to ensure one-to-one convertibility from outside money into inside money. Governments via the central bank, they promise that deposits are equal to cash. Whenever they want to convert, then central bank liquidity provision or supervision, prudential regulation, or even some bailouts from fiscal side, they are meant to make sure that depositors do not lose their money, which is equivalent to saying that depositors can always convert their deposits into cash one-to-one, as if they are outside money. So it means that this kind of a privately created inside money, in some sense, is part of government's kind of a extended liabilities because they're contingent liabilities. If you incorporate this simple idea into fiscal theory of the price level, we essentially arrive at the result that our model shows that broad money, which depends on money creation by banks either by extending credit to government or extending credit to private sector, that's what matters for the overall dynamics. Okay, so those we to show, even though the model is tractable and simple, it generates so many policy implications and quite realistic ones. I also had this list in the paper just to show the realism of this framework. So I will skip those things, but we can go through them during the Q&A session if there will be any questions. So this range from what kind of credit risk channel the model has, what is the importance of liquidity risk, also the underpricing of risk and the resulting credit crunch, whether reserve requirements matter in the interest rate targeting frameworks, what is the cost of narrow banking, and how much deposit market competition can affect bank intermediation and therefore money creation. Also, that policy rate has macro banking determinants as well, which has been frequently underappreciated. That how crowding out or crowding in can happen. Also, what is the impact of QE and and so on. So let me skip those. And then these are also important. What central banks decide on the haircuts and on risk weights, they affect credit allocation. They are involved in credit allocation by those decisions. FX interventions can also have impact on the economy, even though we are talking about this economy that doesn't depend on the rest of the world in any other way. Okay, and then so that's pretty much it on my
Okay.
side. So
Yeah.
let me stop here.
So I would, anyone that would like to ask a question or make a comment, uh, like it's amazing. Um, Bill White recently wrote a paper or did a presentation reviewing textbooks about what that many textbooks still to this day talk about money as if uh, it's loanable funds and and money multipliers and things like this. And so the question, why? And the answer is because we've never had a credible model, workhorse model. Um, and and so that's what my question is going to be because the work that I did with Michael Kumoff and Jaromir Benish in 2014, like it was a non-linear model and so on, and it just wasn't workable because of the assumption of infinite horizon representative Asian models. I didn't think there was enough heterogeneity in it, but uh, uh, but 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 that is the problem for the economics profession that many people didn't abandon models that were absolutely wrong because we didn't have a model to go to and so on. So this is closed economy, and so one question that I've always wondered about is, and you showed it in your slide, I guess. Uh, well, you never said, is it closed? I presume it's closed economy. Is it closed economy, your
Yes,
little model?
it is closed economy.
And and so you showed a little slide, for example, about the effects of permanent increase in government debt, and you had some interest rates rising and some falling, and so on. Uh, the way that we would think about that in a model without banks and so on is that if the model is non-Ricardian, increasing government debt would end up raising the world real interest rate and so on. But but in your model, um, some interest rates go down. I've always kind of curious about how that works. Can you go back to that slide?
Yes.
I was
Perfect.
very interested in that one particular slide because um, it gets at this whole idea, the standard model without banks, that if you have a lot of debt, eventually there's a break because if the model's non-Ricardian and governments don't save and run deficits, that's going to affect global saving, and that'll obviously raise the real interest rate to encourage additional private sector saving to finance the investment and so on. Now, in this graph, you've got what risky loans goes down. So, and you've got secured loans.
Yes.
I'm going
Essentially,
to
private sector loan interest rates going down.
permanently. So that means the real rate would be going down permanently, right?
Yes.
Okay, and securities. So these are like government securities.
Yes. Yes.
So the real interest rate on government securities, the way that we normally think about it, like a bond rate, government bond
Yes.
rate, it would go up. And so what's different is that so tell me the economic story again, please. Why
Yes.
why would the real interest rate on these government securities go down if there's a permanent increase in government debt?
So here the key channel, the way model understands these linkages is via liquidity risk premium. When government permanently expands government debt and banks extend credit to government by simply buying these government bonds, banks have, or the financial sector, financial system as a whole has more portfolio of government bonds, which means that they have a more insurance against liquidity risk. Because if banks see retail deposit outflows, they have more ability to go to the central bank, borrow liquidity, and pledge these bigger portfolio of government securities. Therefore, it means that banks are less anxious about liquidity risk. So liquidity risk premium declines. And the asset side on the bank's balance sheet has two types of assets. One type of asset is which is part of central bank's collateral base, and therefore they insure liquidity risk. Because when banks extend their asset side by these type of loans, they create money, but at the same time they acquire those type of assets that they can use to obtain liquidity one to one and 100%. There are no haircuts on these type of assets, and therefore, even if the whole deposit portfolio of newly created deposit portfolio leaves this bank, the bank will still be able to obtain this liquidity from the central bank and honor the depositor's withdrawal request. These type of assets, they insure liquidity risk. Therefore, they have a liquidity risk insurance premium, or what we call collateral service premium, which is negative. So that these type of assets usually have lower interest rate in the steady state relative to other type of assets like private loans. When private loans are extended by banks, they also create money. But unlike these securities, while they create money, they don't insure liquidity risk. In fact, they increase liquidity risk because when they create new deposits, these new deposits can leave this bank, and this bank may not be able to use its asset side to obtain liquidity from the central bank. And therefore, because of this risk, banks will in steady state charge higher interest rate on private sector loans or those type of assets that are not part of central bank's collateral base. But when collateral base expands, this issue becomes less important. In the extreme, it can become non-existent. Low liquidity risk issue can disappear, which means that these initially lower government bond yields will go up because liquidity risk insurance is no longer necessary. So why would banks hold assets that generate so low interest rates? And interest rate on risky loans will come down because they were high initially because they were generating liquidity risk. But now, if they don't generate any liquidity risk, why would banks charge so high interest rate and hurt credit demand and therefore balance sheet expansion? So when this government securities portfolio expands, that's exactly what happens. Liquidity risk premium becomes less concerning. Probability of liquidity stress declines more than twice as much as it was initially, and therefore banks require higher yields on government bond holdings, and they are okay with lower interest rates on private sector loans because they no longer generate liquidity risk as much as before. So that's the reason why we have this kind of divergence between interest rates.
They're gigantic, right? I mean, like the model, how did you calibrate these channels? Because like when I look at the difference, what it would imply for spreads, for example, if we were thinking of increasing government debt in the real world and stuff,
Yeah.
it seems like spreads like just take the 10-year government bond rate in the US, okay, and plot it with the mortgage rate, like a long-term mortgage rate, and those numbers, move together like and stuff. It's only in times of things like the global financial crisis where you basically get, obviously there's more risk in mortgages and so on because that's where the problem was. But it seems like, for something like a permanent increase in government debt, the effects on spreads are humongous here, aren't they?
Yes, because the increase in government debt is also very large. It's more than 20% increase. So it's like a 10% increase in government securities implies slightly less than 1 percentage point increase in yields. And by the way, I think I should also add that this model has this liquidity risk premium that explains these dynamics, but we don't have term premium here. The model abstracts from term premium. Even though banks are exposed to interest rate risk, banks are assumed to be risk neutral, so that there is no interest rate risk. There is no term premium. And then, by the way, that was in the list of my potential future work on the model. If we introduce term premium, then things can go in the direction, as you mentioned, Doug. If term premium increases, then all types of interest rates will increase. But as long as we have liquidity risk premium as well, there will still be some asymmetry between how much bond yields increase and how much loan interest rates increase.
Okay, Suzek. Suzek has a question or a comment.
Yeah, thank you very much. So I just want to thank Mr. Shalva, and I truly think that we should have more meetings talking about the overall risks in the market from the banking sector, because for the monetary policymakers, this is one thing that they do not consider that much. And as I'm very new at these topics, maybe I couldn't listen more carefully, or I just didn't understand most of the things. Actually, I have two questions. Like, it is coming from the real economy. We see that in this case or scenario, the private investment and the private consumption are going down. And at the same time, we see that the hours of working are going up. As we can see from the other, let's say, scenarios, it's like more case A kind of when we say that the policy response would be much higher interest rates. And we can see from the interest rate the last impulse response function. But I do not understand, like, why do we have this declining consumption and investments? Because its response would be much lower interest rates, policy rates in this case.
Yes, thank you for the question. Yes, indeed, we have a reduction in private consumption and private investment, But if we were to look at the overall consumption and overall investment, it would have likely increased because here we only show the private sector part. In this scenario, what we say is that government borrows and spends this money in the economy. That's why output does increase. But output increase is on the back of public sector spending, not private sector. In fact, private sector spending goes down because of this kind of deleveraging in loans in the banking portfolio. And again, if we look just at the overall consumption, private plus public, it would increase because by definition, output needs to increase at the expense of some expenditure part. In this case, it is budget deficit or public spending part that's increasing output, but private sector and investment are compressed. In fact, actually, when we were discussing with Daga why private sector lending interest rates come down, it's also one of the reasons when public sector spends and creates more money via this public sector debt expansion, then private sector needs to borrow less. And when banks see less demand for private sector loans, this is also one of the reasons why they reduce their interest rates marginally, but still because of the demand constraint. When demand for something declines, then this demand constraint tells that banks should reduce interest rate on those loans as well.
Can I say that in response of the hours of working, the private sector feels like less wealthy after all, and that is why we also see that the overall investment goes down, and so with the consumption. Or if we talk about the hours of work, it's not only accounting for the private sector, but also the public sector.
Exactly. It accounts for the overall economy. The overall demand increases, which means that overall output is increasing and therefore overall hours of work are increasing. So we do have some expansion. So demand is strong in this economy. And there are some inflationary pressures. That's why policy rate increases initially briefly, and that's a response to this temporary deficit spending by the government. But later on, policy rate comes down because, again, this is temporary shock to deficit. Even though it's a permanent shock to government debt level, it's a temporary shock to deficit. So when government started spending at the expense of more debt, eventually they stopped this deficit spending. Debt increase stopped, as well as any boost in output also stopped. So that's positive demand shock indeed. That's why hours of work is also increasing.
Okay,
Is it
thank
a
you.
is
Thank
it
you very much.
actually a shock to government consumption or
Yes.
something
Yes,
like that? Okay, because
yes.
that would explain it. Okay.
Yes.
Rudik, please.
Yeah, thank you for your valuable insights. I had some hypotheses about which I would like to hear your comments. So what I was thinking that each bank has in their mind like some equilibrium level of liquidity that they want to be in. So in case when liquidity levels increases in a bank, what I was thinking that they will lower, it will have downward pressure on deposit rates and loan rates. Because first of all, they will need like less amount of liquidity. So they will suggest like lower rates on deposits. And from the other hand, they should a little bit ease their conditions to kind of get rid of that liquidity by increasing the loan portfolios. So what you would comment about that?
Yes, that's exactly right. So let me go back to the slide which talks about where the liquidity risk comes from in this model. So we have here this is the slide. Yes. So where does the liquidity risk come from this within this model? The liquidity risk comes from the fact that banks initially do not know how much deposits will flow out from their balance sheet, and this C hat is stochastic, and it's not known for banks at the time of loan extension. But this thing on the left-hand side can turn out to be so high that it can violate this inequality. This demand for liquidity can exceed collateral base. Okay, and how can banks avoid this possibility? Maybe they cannot fully avoid it, but they can at least do something that reduces probability of this constraint to be violated. And what they can do is they can adjust their asset side, whether they expand their asset side by government bond holding, loans to households, or loans to entrepreneurs. What they decide on this kind of asset side composition, they can affect this inequality. Even though they cannot affect this C hat, which is random and exogenous, they can at least affect this asset composition of their balance sheet. And when we say that government bonds are part of collateral base but not private loans, what we essentially mean is that this this new SL is zero, so that loans as well as new RL is zero, so that private sector loan assets are not eligible collateral. So these are zero, but this new, or is it mu or eta? Yeah, whatever. This parameter measures the collateral eligibility of government securities. And this, in my calibration, this one is equal to 1, and the rest, they are 0. So which means that if banks extend their asset side by having more government securities portfolio on their balance sheet, they can expand this right-hand side. Essentially, they are holding more of something that opens this access to central bank discount window. So that means if banks hold these more government securities, they have less liquidity risk. If they have less liquidity risk, it means that it's less likely that this inequality will be an issue going forward. It means that this probability declines. If this probability declines, and from the optimal interest rate setting equation, we saw that when there is less probability of banks having liquidity risk issues, this declines, which means that essentially price or the quantity of liquidity risk declines. When quantity of liquidity risk declines, then banks will incorporate less of it in the interest rate, so that interest rates on loans will decline as well. So I think the bottom line is liquidity risk premium will be less. As you mentioned, if governments have more government, if banks have more government bond holdings, because we assume that government bond holdings, they are part of central bank's collateral base. But if central bank's collateral base is already large enough to make liquidity risk irrelevant, then this thing just disappears. So there is no liquidity risk premium because quantity of liquidity risk becomes 0. And therefore, banks will treat lending to government and lending to private sector on an equal basis. So therefore, there will be not much difference between these two types of interest rates. But when we have liquidity risk, then banks will charge private sector borrowers higher interest rate because private sector lending generates liquidity risk, but they will charge government lending lower interest rate because holding government bonds on their balance sheet is beneficial beyond interest income. They get not just interest income from holding government bonds, but they also get liquidity risk insurance because it is part of central bank's collateral base. Does that answer your question?
Yes, thank you. And another thing, like how this can affect if it can, like the sensitivity of banks towards the policy rate.
Yes, that's also a very good point. So again, let's go back here. So the question is, can central bank's policy rate affect liquidity risk premium? So one part is direct. For instance, if in here in the central bank collateral based constraint, in the denominator we have policy rate. If central bank increases interest rates significantly, it means that, for instance, if banks borrow $100 of liquidity from the central bank, they would need to repay 100 and something, and that something can be very high because policy rate can be high. And if that's the case, then the same amount of liquidity risk will need to be backed by even higher amount of collateral eligible assets. So higher policy rate essentially reduces this present value of future repayment from banks to the central bank, and therefore it can tighten collateral constraint. But in most cases, this is marginal. So policy rate has only marginal effect on liquidity risk via this channel, with probably some exceptions. For instance, during was it 2023 when we had this Silicon Valley Bank and like a bank stress period, the Fed decided to lend liquidity to banks on instead of looking at the market value of securities, looking at the nominal value, essentially uh, taking this denominator out of picture. That's essentially what the Fed did. So sometimes it can be an issue, but in most of the simulations I did, this denominator part has not been important. But the numerator part can be important. When central bank increases policy rate, it forces banks to increase their lending rates as well. And when lending rates increase, banks cut back loan extension because of loan demand constraint. Higher interest rate on loans means that non-financial sector will demand less loans. So banks will be able to expand less loans. Less loan extension means contraction in their total assets. So here, total assets will decline, which means that banks will have less exposure to liquidity risk. There will be less deposit money creation, and therefore less of it can be withdrawn or can leave the bank. So because policy rate can create some deleveraging or reduction in bank's balance sheet, it means that higher policy rate moderates or reduces money creation. And because of that, it also reduces the chance that demand for liquidity will exceed collateral base. So that's probably more important channel through which policy rate can affect liquidity risk premium.
You did an interest rate shock too. Can you just pull that up so we can look to see again with the because you sort of have a direct response to the question as well, right?
Yes, and
Actually, I'd like to if you can go to the consumption Euler equation late next. Okay, I wanted to try
yes.
and understand something. Um, okay,
So here,
so
because the
yeah,
policy interest rate cut is very temporary here now, we don't have as much effect on uh, like a wholesale bank stress, bank run or liquidity stress. It has only marginal impact. It increases only marginally this probability of liquidity stress. Of course, if policy rate were increasing, this instead of increasing this probability, it will have declined. But still, it's not very important. That could also be due to my version of calibration. Maybe it's more important in reality, but at least in this calibration, the impact of policy rate on liquidity risk premium is small.
and you go to the consumption Euler equation, please, because um, so it's the growth rate of the money, or what is it? No, sorry, it's MT. It's minus. Like, why wouldn't you write that as plus and then have m hat t plus 1 minus m hat t, and then that would be the growth rate, right? Wouldn't that be more
Yeah, so the
more intuitive?
interpretation is, so what does MT hat stand for? It's essentially how much real money balances deviate from consumption level. So if real money balances are higher than consumption in the current period, then it means that households will be increasing their consumption to make sure that money balances and consumption become in sync again. And the reason why we have this MT and then MT minus one, it's essentially how preference shocks enter the standard DSG equations. And in preference shocks, what we have is essentially preference shock in T minus preference shock in T plus one. But we have the same structure here, which shows that essentially we somehow micro found in a way these preference shocks. Instead of it being a shock, it's actually money creation, which can be affected by banks themselves. If banks decide to charge different level of risk premia because of mispricing of risk or being more concerned about risk, being more conservative, they can affect money creation, and therefore they can affect real money balances, and that can affect consumption just the way preference shocks affect. So that's the
And
only, just to create resemblance with the standard equation.
the interest rate term is IM, but you have different interest rates in your model. So what is IM?
So the IM is interest rate that households get on their money holdings, and they can hold money in the form of deposits or in the form of cash. So in fact, so here, if we go back to that equation where we talked about the liquidity risk, we said that the demand for cash is represented by this. Actually, it's by the first part, C hat times deposit portfolio. So actually, it's provided here. So C hat fraction of overall broad money is held as cash, which has zero interest rate, and the rest is held as deposits. So IM is essentially weighted average of deposit interest rate and zero. So that's the only difference.
I think it would be wonderful to, would you solve the model in? Is it Diner,
In
Iris?
Diner, yes.
In Diner. I think what's really neat here, and we're over the 6 p.m. kind of time constraint in Yerevan that we like to respect, but it would be really neat if you could like send us the slides and the code, the Diner code, so that people could play around with this. But this is an amazing accomplishment, Shalva. Like I think you've really made an amazing amount of progress here. But are there any more questions or comments that people have? I don't want to shut anyone down here. Um, Anahit, Satanik, no, no, going once, going twice. Okay, okay. Thanks, Shelba.
Thank you, Doug.
Uh,
Thank you very much.
this is wonderful. And enjoy your time in DC. Okay.
Thank you. Thanks, Doug, and thanks everyone for questions and participation.
See ya.
Thank you.